I'm joined from our Melbourne studio by Dale Gillham. He's the Chief Analyst at Wealth Within.
Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale.
Hello. Finance expert Dale Gillham from Wealth Within. It's nice to see you.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
good evening and welcome to Wealth Within Live, the Australian stock market show where you ask the questions and we give you the answers about all things investing and trading. Now tonight we're going to share with you why you should not listen to the media if you want to make money. We'll also talk about the risks you're taking and how to manage that properly. We'll also give you our thoughts on the Australian market stocks, look at current trading opportunities, answer all of your questions and a whole lot more. Hello, I'm Dale Gillham and joining me tonight is Janine Cox, and we are Australia's most trusted stock market educators.
Hi everyone, it's great to have you all back for another week. I must say I'm really excited about what we have for you tonight. Before we get into things though, remember that the chat box is off to your right, so get typing and we'll get into as many as we can.
Well, that's fine. Oh, we will, because I know there's quite a few people on already and there's a few questions there. Now, I know you're going to ask if I've conducted another poll, because I knew you were going to just album me and say, have you got another poll? And you'd be right, because I actually did do another poll. And this poll I asked...
That wasn't the question I was going to ask you, actually.
What were you going to ask me?
Look, I was just going to ask you, did you do your facial routine for the evening?
My facial, yeah, I did all my facial routine. I did all my pampering and all that sort of stuff. You know, when I go to Channel 10, I sit in the green room, not the green room, but in the makeup room, and they spend about 10 minutes on me. I must be pretty ugly.
You must be special.
They don't do that on 7 and 9 on the other channels, so I need a makeup girl.
So you're not a metrosexual, is that what you're saying?
No, I'm not one of those.
Don't put the cream on every morning?
No, I'm a non-specific sexual, something like that.
Thank you.
But in this poll, let's get back to the serious stuff, because I know everybody wants to talk and get into the stocks, but this poll was so I asked the question, my tolerance to risk is. Now, the answers they were able to give were low, medium, high, and very low. So, then the results were quite interesting.
Now, they were actually really surprising to me. 49% are saying that their tolerance is really high, 9% very high. And I suppose this is congruent with the 31% of those who responded to last week's poll saying that they'd like to over 30% growth each year.
Well, yeah, if you want over 30% growth per year, you've got to take higher risk, don't you? Well, sorry, not necessarily take higher risk.
Well, the higher the return, the higher the risk. That's what you've always said.
Well, it is. It's a correlation. The higher the return, the higher the risk, but the higher level of knowledge to manage the risk, so you don't take...
That's the most important part of it, isn't it?
It's the most important part of it. But we also got a couple of people commenting on the actual poll. And first there was Steve, who actually says depending on the stock, medium to high. So his risk, depending on whatever stock he chose, whether it was medium to high in terms of the risk. That's really good thinking in terms of, and all good traders need to think like that. And a lot of people don't look at stocks in terms of the risk they're taking in each stock. They just think they're taking the same risk, and
that's a really good point.
And well, it's because it's just lack of education or lack of understanding. Like some stocks are much higher risk than others, and we've seen a lot of what I would call DOG stocks being asked of us.
How can you compare some of those little stocks we talked about last week with a BHP?
Well, you can't.
Or a Rio,
in terms of risk, it's just chalk and cheese, isn't it? It's really like you're sailing on the Titanic or you're on the Queen Mary, one of the two.
Hang on, that sort of makes sense then, because we've had quite a few people bringing up those stocks. So maybe if the majority are saying that they're quite comfortable or want their tolerance to risk is high or very high, maybe that's why we're seeing some of those stocks there. But I mean, from my point of view, I think, when you're thinking about risk, people are not actually being completely honest about it. Or
they're not.
They don't understand what they're actually really meaning, I don't think.
No, I don't think so. But that leads us into the next comment from the poll. And this one we had a comment from somebody who's aptly called, I don't know what it's aptly called, but he was calls himself Death Bum. I'm not sure why.
Maybe you want to tell us why.
I'm not sure why.
I'm intrigued. I want to know.
Yeah, Death Bum, who wrote, I have to say that most investors that manage their own portfolios are probably high risk takers without actually realising it. And I 100% agree with that. He
For
goes
a
on,
funny name, he's actually making a lot of sense.
well, he does make a lot of sense, even though he's got a funny name. So, but from that, but he goes on to say they would lack the proper education, knowledge, experience of the market, and they think they are investing when actually they're speculating. And again, I 100% have to agree with that statement. A lot of people, I mentioned it last week when I said people are delusional, and a lot of traders are delusional when they're trading. They're in this whole, they say ignorance is expensive, and in the stock market it's disastrous a lot of times, and that's why I mean delusional. A lot of people think they're traders, or they think they're educated when they're actually not. Now this Death Bum goes on to say a contrarian investor might be a high risk taker, but an experienced one is less of a risk taker than someone inexperienced. 100% agree. Who can't tell the difference between investing and speculating. Again, I agree with that. What do you guys think? So to me, really good comments there, because I do find that when I'm chatting to traders or people ringing us up about our education or asking questions, 99% of them are oblivious to the risk they're taking. They just they think, oh, well, I'm doing this, so therefore it's low risk, or I'm not risking my money. They don't understand leverage. They don't understand how leveraging works. They have a surface level of that sort of stuff. And they don't know how to measure risk, I think, in terms of stock risk, market risk, and risk of themselves in that marketplace to be able to manage that.
That's a really interesting one, isn't it?
Yeah, it is. And it's just, you could have...
Without proper experience.
Correct. Yeah, absolutely.
Without proper training, how do you actually measure that?
Well, it is. You don't know how good you are until the market challenges you, and most people, and I dare say, I can guarantee, if I asked everybody to put their hands up who's watching, who's got a trading plan, and I can guarantee 90+% of the people watching tonight don't have a trading plan.
Or a proper one.
They've just got a rough idea, and if I ask you to articulate your trading plan, complete with your risk and money management rules into that, most people would just be going, while I do this, and it's quite wishy-washy. And to me, that's, if you're doing that, then you are a speculator. You're not a real trader.
Yeah.
You're not somebody who manages risk.
I mean, you were looking at the correlation between people saying that their tolerance is high, so risk is high, and the growth that they wanted was high. And the reality is that we were saying before that most people don't really comprehend the risk that they're really taking. But in actual fact, when you get down to the questioning with people, they actually don't have that higher risk tolerance.
No, they don't.
Yeah, that's the reality. So and we know with guys, remember we used to run an art of trading workshop every year. And we always got a more, we used to put this little chart out, and we'd ask people, can you tell us where you are? Like if it's sort of like a line you draw in the sand, and this side is 0 and this side is 10, where are you between 0 and 10 in terms of your experience, your knowledge, psychology, skills, all of that? Now, the guys would always overestimate where they were, generally. That's
absolutely.
a rule of thumb, and the women would underestimate where they were. And I don't find that with all guys, because I'm working with some who actually, you have to actually get them to see, well, hey, go back and look at the email, the first one you sent to me, and now look at the emails that you're sending to me, and it's chalk and cheese, and you've come a long way. But generally, that means that guys, and if we're looking at what percentage of male was watching?
90%, wasn't it?
Yep. So if it's mostly guys out there watching us tonight, then maybe you better just sort of peg it back a bit, because your real tolerance to risk can be judged by whether you actually have a good set of rules and you follow it through. And 9 times out of 10, I find that when the real you comes out when you've got to follow your rules, like things like this happening when the volatility increases on the market and then people jump out rather than waiting for the rules, that is a sign that your tolerance to risk is not as high as you think it is. There's also another measurement, whereas if you had, say, 3 losses in a row, how has your psychology been affected? And if you are impacted by that, and it's not like water off a duck's back, then there's probably something wrong potentially with your trading plan that you need to review, so it needs to be updated. But also your risk tolerance is probably a lot lower.
Well, I think if you're sitting there tonight and you're worried about what's happening on the market, you're not a trader. You don't understand risk
yet.
If you are worried about a stock falling away or your stock's falling away tonight because of what's happened on the market today and what you think might happen, again, you are not educated enough, and your tolerance to risk is not as high as what you might think it is, because that's really the leveler. If you're ever worried about a stock you own going down or a trade you're in going down, that means you don't know how to exit. That means you don't know how to manage risk properly, and those sort of things. And I'm not trying to be rude to anybody. I'm just saying that the best traders know when to get in and when to get out. They don't guess. Like Janine and I couldn't care less whether the market went down 400 points today or 4 points today, because we have a strategy and a plan and a process. And even during the GFC and the biggest meltdown days of the GFC, Janine and I were just calm as. We just knew what we were doing, because it was about knowledge and experience and having a plan and a process that's well thought out, documented. So it was just follow the plan, and it is simple as that. And if you are guessing all the time, then your risk level is very, very high. And if you're saying you're a high risk taker,
and you're not congruent with
you're not congruent with all of that. So therefore you'll make emotional decisions, you'll make mistakes, which means your trading will be inconsistent. You'll have some nice wins every now and again, then you'll have some big losses. You'll wonder why you didn't get into some trades and why you stayed out of other trades, why you stayed in too late. There'll be a whole range of things going on. But most of the time it'll be more confusion a lot of times.
And in a market like this, you might say you've made really good profits on some illiquid stocks. That's then justifying what you're thinking, really, isn't it?
Yeah, absolutely.
And then setting you up for failure when the market eventually has a correction or has you second guessing yourself. So just the true test is not when the market goes up and what it is. It's when the market actually falls, like Dale was talking about before.
Yeah, and that's the thing, is it's about making wise or trader-like decisions, and I find most people can't do that, or they don't do that much. And that's why I said earlier, your education is going to cost you one way or another, and ignorance really is expensive. But I think we've had a nice discussion on that. Well, it is, and people don't like. I get people on the phone and they go, "Oh, I've lost 100 grand or 50 grand or $200,000," and they spent 3 or 4 or 5 years going through that process and losing money and being inconsistent. But people don't actually look at the loss in profits that they're not making because they're uneducated or they're inconsistent, or the amount of time they spend trying to get it right when they're doing it the wrong way. Like, you can have 1 year's experience over and over and over, the same year's experience for 10 years, or you can get 10 years experience in 1 year if you do it the right way. So you can actually learn to do it properly. And that's really what we teach. And Janine really pushes back testing, and so that's where you get 10 years experience in 1 year. But if you're repeating the same year over and over and over again that's wrong, then you're just going to be wrong, and you're not going to be trading really, really well. And I find that's what a lot of people do. They play around the edges trying to get it right, but they keep doing the wrong stuff over and over and over again, rather than actually learn how to do it properly. And that's really what it's about. So we're going to have a quick look at the market, because I know we've got a couple of questions here. So that'll give me a chance to look at the chat, and then we'll come back to the chat after you have a look at the All Ords, yeah?
Fantastic. Yeah. Well, look, it was a bit of an exciting day on the market, wasn't it? And you're probably wondering, why is she using those terms when it's fallen? But it is always good to see the market eventually come back, because then we're just starting to think about the next round of opportunities that come down the track after the market's fallen. These times give you an opportunity to do one of two things: either short the market, or to be spending the time preparing for how you're actually going to put money into the market in the next move up, and also to sell off existing positions if you haven't sold them already, to just revise what your rules are and make sure you're on track with all of that. Now, looking at the market, you can see that from the open to the close, it was actually down 0.84% today. Now, the whole range for the day, I'm just going to click on that bar so we can see it, was about 91.7. And look, the whole the whole range measured in percentage terms was actually 1.4. Now that's not, it's one of the biggest moves we've had in a while. We had another one going back on the 6th of May, so the range was about the same again. But just to show you by comparison, that is pretty normal for when the market starts to fall away. But often the media make a big deal about it. If there's one day down on the market when it's like that, it doesn't really mean anything. What you've got to look for is when there's a bit more of a consolidation in the market like this, like we saw in 2018 when the market was trying to move up, opens and closes were really hanging around the same level and the market eventually dropped out of that. Now, so far, this is really an orderly pullback on the market. We know that there's a lot of machinations going on between the Chinese government and the US government, and that the Chinese government pulled a Trump card, which caused a bit of volatility on the market. But I'm actually saying, great, thanks for that, because we needed the market to come back. It was due for a pullback, and you just delivered it for us. Now, there may be a bit more to go. We'd like to see a few weeks down, 2 to 3 weeks down at least on the market. Now, so far, looking at the weekly chart, you can see it looks hardly even a move. Look at it overall. As percentage-wise, and we're going to talk a little bit about what's said in the media a bit later on, but it's only 3% down. Now, compare that with how far it actually rose on this run. And in the scheme of things, it's nothing, putting that in perspective. It's 18% up. Now, often when a market moves up and you get these little consolidations on the rise, you'll see the market pull back into those consolidations. So we could see the market come back anywhere between this 6,096 and 6,000, say 230 points to settle down. That would be what we call a more normal pullback. And the more aggressive one would be between the next two levels. Now, these percentages that you're seeing on the side there, that's some of the stuff that we teach in the course that we have, the diploma of share trading and investment. If you're thinking about doing some education, then you really need to get to it and find out about it, because there's no point finding out about it when you've already lost the money, or when you're thinking, oh geez, I'd like to get more out of the market, but I'm just not getting what I'd like to at the moment. Don't muck around with it. Just get really serious about it and say, this is what I need to do. I need to get an education and get it right. So looking at that, only 2 weeks down, we had this inside bar. So the high of that bar was 6473. The high was actually 6477. So technically it's 3 weeks down already. And, that's nice to see. But in terms of the range, as I was saying, it's not down into the range that we'd expect to see for this type of pullback on the market. So how are we going there, Dale, with the chat?
I'm fine. I think it's been there's a whole lot of chat going on in here. There's a few stocks you can start whacking in.
Okay.
So there. I'll answer some questions while Janine's doing that, but I've got Jazz Mac said, do I exit the market until the election has been decided? No, election's got nothing to do with the market. So
Well, you do what you think you should do, but what we would do is we don't make decisions based on whether whether these things are going on overseas.
The statistics
China,
are elections have no influence on the marketplace at all. It's just not there. So
you have rules, so you're operating according to your rules, and you're not being jerked around by the emotion that happens from all these different things. And
start typing.
Okay, I'm getting told.
I'll keep it. D-Wave saying stock down, crypto up. What a day. Big deal.
I can't read your writing.
Tomorrow might be stocks up, crypto down. So Afterpay. Todd Martin, my gold miner stock was up and Telstra stayed even. Both stocks I have a little hedge in a gold miner. Great, Todd. That's really good. Fiat. Jazz Max said fiat. Flat dollar's on its way out. Debt no longer sustainable. Funny how Trump is bringing back manufacturing. Yeah, it's good. Look, I don't know whether it's a bumpy ride ahead. I don't think the US market's going to crash. It's not in rampant speculation right now. I think there's a lot of news. And we're going to talk a bit about news and what people are doing. Chaotic Ray says, hey, what do you guys think about Forex? Forex is really good if you know how to trade. But 99% of people that ring us asking us about Forex. We get so many Forex traders coming to us saying to me, hey, look, I've been trying to trade Forex. You need to have good rules, good structure, good strategy around you. But Forex is not an issue to us. Like it. Steve Hunter's Afterpay you just put in there. Chaotic Ray says Afterpay is trash. Guys, not appropriate comment, please. it's not really an appropriate comment. Chaotic raise. Afterpay's not trash. It's a reasonable stock. It's here to support each other here. What's another one? What's the question? There's a couple of other questions here. Can someone explain leveraging to me? It says in the course that it's bid minus the ask, but how does that affect the trader? Leveraging is not bid minus the ask. Bid and ask price are just what things are trading at. So what somebody's, a buyer wants to bid for stock and the asking price of the seller, that's got nothing to do with leveraging. But you might like to, if you want to shoot me an email with where you're getting this from, I'm quite happy to answer that. Just info at Wealth Within. I'm quite happy to answer a little bit better, because leverage is when you're using, in serious, basically using somebody else's money to get into the market. So you might have $1,000 and you might borrow $10,000 from a bank, margin loan, something else, or you might use a CFD or an FX where you're putting up a margin and you're getting a larger exposure. That's leverage, not bid in the ask price. We've got a couple of other things here. Ian saying the Trump-China trade war triggered some volatile activity. It tested my ability to stay true to my X rules versus reaction. That's great. It's testing your rules, but stick to your rules, because your rules will be right. And right now we're in reporting season here in Australia and the US, and that causes volatility anyway. But
and it's not just about what happens now. It's about when there's volatility next time, or when there's talk about all of these things happening in future, similar things, because there's always going to be something going on. It's how you then respond in future. So you're creating almost like a discipline, and if you're not following any discipline, then you're going to repeat the same sort of knee-jerk reactions to the market otherwise.
Yeah. Last one, I'll get some. There's heap more here anyway. Last one says gold, crypto, cash for the upcoming crash. Janine, I don't think the market's going to crash, so I don't agree with you at all there. Especially, it's just, I don't think the market's not going to crash. It's stay in stocks and have your buy and sell rules there. But let's go into some of the stocks. So we've got Afterpay. So we're going to have a quick look. We haven't looked at that for a couple of weeks, have we?
Oh, look, it comes up every so often. I can't remember when the last time was we talked about it, but it just, I've got it imprinted on my brain because quite a few people ask about it, and we get asked about it on the Traders Forum as well. So looking at Afterpay, we can see that definitely the momentum's slowing down, but it is only partway through the month. So at the moment, we're halfway through May, so we can't really make a judgment on the monthly bar at this stage, but clearly April was really strong. And of course we expected the stock to continue to rise after a strong move like that, and it has. And looking at the weekly chart, look, it's really important that you have a look at how many bars are moving in the upward direction and how many in the downward direction, because once you start to see more bars moving down than up, that's telling you that something is about to change, like what we saw here when Afterpay started to fall back. But it's still a bullish stock while it's going up like this at the moment. But I wouldn't be looking at this stock from a point of view of buying right now, because it is quite extended. However, it could go up a little bit higher. I was expecting it to at least crack around that $30 mark. Hasn't quite done that, so look, it may fall short. Sometimes when stocks move up to important levels, they actually turn before these levels or between levels. So that could be what's happening with Afterpay there, but looks all right. So that was done. So now the next one.
You can say his name, because I can never. I'm not sure if I'm getting it right. For Aristocrat Leisure.
Corso, is that it?
A Corso, I think it's supposed. Please excuse us if we're saying that wrong. But Aristocrat Leisure.
Yeah, look, it's been a lovely stock over time, how it's traded up beautifully. Of course, it has changed. We can see this really strong action on the downside that happened into December 2008 that really broke the momentum, and it's really been struggling since to get up. Now, you know that the rest of the market has pushed on and gone back to its prior high, whereas Aristocrat has really struggled to do that. So it is moving up nicely. There could be a little bit more upside in Aristocrat. However, I'd be watching it a bit more closely as it's moving in this current direction. I'd like to see it stay above this low at 24.70. Because otherwise it could head back down to this low here in the short term. So just a watch on that. Sometimes that there are movements that happen after highs that we call distribution. That's one of the areas in the course that we talk about. So it's an interesting area to watch when you're looking at stocks to see whether they're actually in what we call accumulation or distribution, because distribution means that they're more likely to keep falling. So that's two stocks now. The next one is Sol Patterson, Washington.
That's for John Granger, your friend.
John Granger. Oh, hello, John. Looking at this stock, wow, what a volatile ride it's had since this high in November 2018. So while the market was actually pulling into a low in the end of 2018, this stock was actually moving contrary, which is really nice to see. And I'd like to look over the history and compare it to a chart of the rest of the market, which Optima allows you to do. If you've got this software, you would already know that you can do an overlay, which allows you to put the All Ords over the top of it and see where else does it follow the market and replicate it, or do the opposite now as it's done here. So we've seen this stock pull back quite heavily. Well, let's have a look at the percentage from the high, and it's around 30% right to this recent low. Now looking at it, the move down, slowing down. So we had this big commitment to the fall in April 2019. This month, so far, the bar's nice and short. We're starting to see a potential support here on the weekly. We can see the opens and closes at the same level again, indicating that there's more equilibrium in terms of or agreement in the price. When the bar's like this and really strong down, that means that there's disequilibrium, that the sellers have got control. So I would just sort of, if you're looking to buy this one, I'd say it's not even close. Did you have a specific question?
I'll go and have a look. I don't think so, but this stock's been an interesting stock over many decades, hasn't it? It's been
It has.
really
Look,
good
at times it trades in a sideways action like it did back here through 2016.
No specific. He's in them, but looking at the moment. I'm not in them, but looking at the moment. Sorry, he's not in it. So.
Yeah, well, look, for rules to trigger, it's going to be a while because there's not even a setup that's there ready to be able to trade it. So in an ideal world, I guess I'd like to see it go up in the short term, maybe somewhere around this $25 mark, and then actually have another pullback because then the challenge is there to be able to get back into it. NAB, okay, so NAB's looking terrible. Like I was going to say another word, but I thought I'd better not do that at this prime time. Looking at the stock, we've seen massive resistance. I think we've done NAB too previously, but huge resistance around that 34 mark. Looking across here, there's support and resistance through here, which given this week's bar has taken out this low. So this is why you've got to watch out for these previous lows. If a stock takes it out in a big way, then it could indicate that there's a further fall to come. Now I'm looking at the big gap down on the stock. Now that's huge. Look at the size of that gap on NAB.
Massive.
Let's have a look at the percentage while we're here, just quickly. You can see there that it's dropped about 4.7% just in one day. So looking at that, it means that often the stock will come back up and fill that gap, and I'll just get this thing out of the way. But at the moment, I wouldn't be going anywhere near NAB. It's not even on our preferred list. We wouldn't choose NAB over other big banks, not for a long time.
No. That's all right. So we're gonna get some more stocks later.
Okay, so stop now.
You've done about 4 or 5 in a row, so that's okay. So we're gonna get into more stocks a little bit later, guys. So just keep typing your questions. There's a whole lot of stuff there in the chat. So keep up the good work. But now, Janine, I actually know you wanted to discuss something about the media, or discuss the media, because that's not only it come up a couple of weeks ago, and you wanted to discuss it last week, but we ran out of time. But even more so today, given what's been the media. Can I say the media always calls me to make comments, like I had Yahoo Finance ring today. I want to comment on the marketplace, and they do that when the market's falling or supposedly falling because it's fearful, but they never ever ring us when the market's going up strongly. So the market can fall 2% in a day, they ring and go, can you give us a comment? But if it rises 2% in a day, they're nowhere to be seen. You can see the tumbleweeds running.
What that indicates is the observer or the listener or watcher of what's going on in the market being more attentive when all of that stuff's coming out. So if you guys don't care anymore, what the market does, then that probably won't perpetuate like that.
No.
So a couple of weeks ago, one of our direct equity clients shared how he'd seen on the news a report with a very brief snapshot of what had occurred on the market that day. And he actually watched it the following night. The market had actually fallen around 20 to 30 points. And his comment was the comment was by the person who was reading this out, it was a bad day on the market. Now I'm going to show you a chart and talk about that in a minute. The following night, on the same report, it was revealed that the market had risen by 40 odd points.
So rose more than it fell the day before.
Yep, and the comment was that it was a lacklustre day on the market. So what the? well, this is what this person said to me when I was having a chat with them. Please explain.
I know, but it's just the BS that the media put out, and people make their investing decisions based on journalists.
Yeah.
And to me, I do crack a joke that, has anybody ever met a rich journalist,
But if it was a slow day on the market, they've got to find something.
What is a slow day on the market?
To talk about, because that's their job. So, and if on that day when it was a bad day on the market because the market fell 20 points, that was the important and interesting thing. And so people are left there watching the evening news and thinking, oh, geez, it was a bad day on the market, not understanding what 20 points represents.
But if our market, market was down, 90 points today? Or it fell down 90 points. It ended up, it fell down about 90-something points, but it came back to be less than 1% down for the day after being about 1.5% down.
Well, it's showing how resilient our market is.
That's just amazing. That's really resilient. But if our market goes up 1 or 2% tomorrow, I can guarantee you the news won't be as emotional as it was today.
So you're saying that our commentary on the market's going to be completely opposite to what the mainstream will hear?
Pretty much most of the time it is.
Yeah.
Because it's like journalists ring up and say, Dale, the market's crashing, it's gone down 1%. And I said, well, it's gone down 1% 37 times in the last 4 months, but it's gone up 1 and 2% on a day 37 times in the last 4 months. So what do you do? And that's really, the media is just looking for a story. And you can see even on this chat, that you guys are talking about, people are talking about the market crashing and everything else. The market, and I'll say it again, our market will not crash. It's not going to do it. It's not possible for our market to crash right now. None of the signs are there for a crash. And if you think there is, I think you need to learn a little bit more. Our market's nice and bullish. It's resilient, as Janine said before. It's not going to crash. So which was the day you're going to show?
Well, it's not a specific day. I just want to talk about this in context with what we've got on the Optimist Screen. So first of all, if the market fell about 20 to 30 points, a move in one day when the market's really doing nothing, look at that little tiny bar, is 20 odd points.
It's 20 odd points.
That's nothing on the market. When the market has a great day, it's 40 odd points. That's a really good day, but they were saying it was a lackluster day. Here's another one. This was an absolute boomer on the market. The range was 136 points. But, to us, seeing these moves, 30 to 40 points, is a really good move on the market. It's just confirming what we're expecting, and often means that if it closes high on that same day, it often means it's going to continue to go up the very next day as well. And so then it just sort of puts another piece of the puzzle together for us and for you as traders as you build up your knowledge in all of this. But, that was just to illustrate the point, really, to show the chart.
Yeah, and it really is. And the thing is, it's like Janine and I don't care whether the market's going up or down, as long as it's good. It's doing something because we've got a plan for both ways. So if the market did crash tomorrow, it's not going to worry Janine and I because we have a process and a plan and a strategy. That's what I was saying as before. The market will go up, it'll go down, it'll go sideways. What's your plan for each one of those? And that's really what we're saying is to manage your risk. It doesn't matter if the US melts down tomorrow and it goes down 300 points or 500 points or 10,000 points. It's not going to change Janine and I and how we're going to manage our portfolios, and we'll still be profitable for our portfolios with our people.
And just look back in history because the chances of it doing some of those big falls that you mentioned are pretty slim.
It's just super slim.
when the market's already been falling, so this is what Dale was saying before about, it's already been up 41 days or 30 and down 41 days. Look at this here. See, this range is 170 points. That was a big move.
That was a big move.
But the market had already been falling for a long time, and it had already given you an indication that it was going to keep falling. So this was no surprise to see that sort of move. And you've always said, look, markets don't crash at the top, they crash at the bottom. And we're at a high right now. So therefore, the market could keep going down, and it could go down, slightly further than what we're expecting. But we look at what's probable, what's the worst case scenario, and what's the best case scenario for the market. So that way, for us, there are no surprises when the market actually does unfold and move in either way, and we've got a plan and a strategy to manage it regardless of which way it goes, as Dale was saying.
Yeah.
So did you
No,
want to
but
add?
it is. It's true. Exactly what you're saying is, that I'm pretty sure most people would never consider what makes a market stop rising and or stop falling, and what makes a crash. And what is a crash? Most people can't really explain what a crash is, and why a market crashes, and the psychology behind it, and the technical stuff behind all of that. And that's why we say markets don't crash at the top, because markets are about rampant speculation. Our market hasn't even made a new all-time high, so there's nothing rampant about our market
Well,
at
let's
all.
have a look at how far we are.
And if you look at the Dow, if you go and have a quick look at the Dow,
Actually, I better hide this because that's going to confuse
well, you
people.
look at, that's the secret stuff. You got to have the handshake
Well,
to see that.
You jumped ahead. Look at our market first. So we're still below. We're still below this point here. And now you want to look at the Dow, as you were saying before.
Yeah, it's just down in the red there. Yeah, just have a look at that. See, look at that. So if you look at it on a monthly chart, it doesn't look bearish at all. It's just, it's got 3 tops there at the moment, but it's not overly bearish at this point in time. And so to me, it's right up the top. So there's no reason why we're thinking that the Dow should be crashing at this point in time. Yeah, there's a little bit of increased volatility at the moment because reporting season, a few other things. But China needs the US, US needs China eventually. They're not playing really well in the sandbox at the moment. They're probably throwing a bit of sand at each other. But later on, they're going to kiss and make up and they'll get on with it. And because they really do need each other. So it's just about postulating and trying to get, as people negotiate, one person wants to be a bit more stronger than the other, but eventually they'll work themselves out, they'll have a hug and a kiss, and then they'll get back on with it. But at the end of the day, this is not showing us it's bearish. It really isn't showing us it's bearish. So let's just go and look at the chat a tiny little bit more, because there's a few things in here. The person who asked about leveraging, it wasn't about leveraging. He qualified and said it was at the bid-ask spread. So I'm pretty sure I answered that. I answered that. So let me know if I didn't. Somebody's asking me about my book again, if it's on Google Books. No, I don't have a plan to put it on Google Books. You can get it on Amazon. There's a a Kindle version on Amazon if you want a Kindle version on it. I don't have a plan for it. Somebody asked, do you guys do Forex also? We teach people to trade. That's what we do. You trade what you like. And I always talk about it like trading, driving a car. You are a driver, and I talked about this last week. The driver is the skill that you have. What you drive, whether it's Forex, stocks, options, warrants, futures, commodities, currencies, you name it, it's up to you. We'll teach you to trade. That's what we do.
We have got a Forex CFD course.
Yeah.
But we can make a few comments about that. I was speaking to someone today who actually, he wants to have someone else managing his Forex account, which to me was straight away, I thought, oh
why
my goodness, why? And often it's going to be a broker who's doing it. And if you understand that industry and you understand the risk involved and how they can take the money off individuals. And we once had a discussion with someone who'd been speaking to a head of one of the Forex broking houses that left the industry and said that he wouldn't actually, he was asked, would he actually as an individual go and trade Forex? And he said, no way.
No, he didn't.
Because it's all
he said
stacked
that
against me, so why would I do it? That's what his comment was.
Absolutely. And I was having lunch with them at the time when that came up. So, and it is because Forex is, when the Forex market is played by the biggest people in the universe, or in our universe. So you're talking about the biggest industry. It's gazillions of dollars get traded through it. So the biggest, brightest minds and the biggest money goes through that. So basically, if you think you're better than these professionals, then go right ahead and trade Forex. But you've got to have a solid strategy to beat them, because their whole and sole job is to take the money.
Well, your first job is to actually understand your risk, and the second job, and part of that is understanding what do they actually do? How do they take people's money, and so therefore how can I protect mine? And then think about the strategy from there. But I can say that 90% of people, even 99% of people, I should say, that have never traded shares before, eventually they're going to take your money because the system's designed that way, because they're actually monitoring how you trade, and then you might get it, they'll let you have a few wins, and then eventually they'll just take your money once you get into it.
Well, they do that to let you have a few wins so that you put more money in the account, because they classify clients in A, B, C and D. So if you're making more money out of it, they make it harder for you to make money by changing some rules of how you're placing your trades and re-quoting you, that sort of stuff, because they know with 100% certainty that 90% of the money in the accounts that get open with them, that becomes their revenue for the year, because most people lose. And if you're using their systems to do all your analysis, you're actually playing cards with your hands on the table with them. They actually know how you're doing it, whatever you're doing, and then they'll use it against you to start taking your money. That's why a lot of people struggle with Forex. You need to be very highly skilled to consistently make money year in, year out on the Forex market. You need to understand how these guys work, all these institutions work, because their job, the Forex market is, I take a position somebody else takes the opposing position, and either they pay me money every day, or I pay them money every day, depending on which way the position goes. And that's really how it works. It's a game where I'm paying you or you're paying me, and if I'm better than you, you continue to pay me. But the point with FX providers is that they know the rules and they control the market basically to a large degree. Sorry, not the market itself completely, but I'm talking about they controlling the platform. They're seeing what's going on. They're seeing what you're doing. And then they use that to entice you to do certain things so they make more money, because that's what they do. That's why you do need to be highly skilled to trade FX long-term consistently. But most people, it's lamb to the slaughter. That's what we see constantly. Pretty much every day we get people coming to us, ringing us, saying, I've been trying to trade FX for years, days, months, centuries, whatever it is.
Yeah, someone I spoke to said that they'd actually made 500 or 5,000 euros, and then they put that away and then decided to go back in with this particular broker, I'm assuming it was, and they put more money in, and then they lost
a lot.
Lost that, but they still claim that overall, of all their trades they came out with 5,000 euros at the end. But the final part of their account was totally gone. There was nothing left, and they got an email saying, oh, we've had some bad trades at the end. Now, to me, that's just showing an example of what the risk is. So just why venture into that when you really have no idea? You need to be highly trained, as Dale was saying. So did you want to talk about a couple of stocks now?
In a second, I've got a couple of questions, then we'll go back to the stocks. D-Way saying, hey Dale, can you do a tutorial on how to short the market? It's in our short-term trading course. I teach that, so if you want to learn that, go to do our course, but you need to have done our diploma course to get into it, because it's really, really high level. Not high level, what was I saying? Advanced is probably is more. It's a lot more advanced techniques. It's not something I'm going to do a free tutorial on, because it's just would be, even though I'd be giving you some knowledge, it would just be dangerous. There's not enough depth in it something I would just do for free. Let's go back and look at some stocks at the moment, because there's a few things happening.
All right, so have a look at Origin Energy. I think we talked about this not long ago, maybe even last week. Look, it looks quite nice at the moment. It's just been consolidating sideways. Potential upside is somewhere around this 34 mark. But at the moment, it's actually pulling back. So with the market coming back today, we've seen a little bit of weakness in the share price. There is a gap there on the daily chart. So if it falls a little bit further, it will come back and test that gap, as it's done when it filled this gap. So let's just see what it does. We don't want to preempt it at the moment, but it is still trading sideways right now. A nice move above this point here, $7.76, would indicate that it's going on to the next level. So that's Origin. RWC we've got here.
Yeah, that's from Todd Martin. Thanks, Todd, for that.
Todd. Yeah, look, Reliance World Corporation, that's something different. The stock's plummeted today, so look, clearly it's gone down much more than the market. So let's have a look at how far it's actually gone down.
I was asking if it's an opportunity since the downgrade. I believe their problems are short-term based on US weather for past 6 months.
Who cares when you're looking at the chart like that? That's all I can say. I don't care what they write about it. It looks terrible like right now, and there's no rule to be buying it. The sellers are overweight this stock. So whenever you see that, don't try and be different and think, oh, okay, it's gone down heaps, I might be able to get it cheap. Well, okay, it may come up and fill the gap, but you're taking the highest possible risk when the longer term direction is clearly pointing strongly down. So the question is, do you want to take the safer money, or do you want to try to, lick your finger, put it up, hold it up to the wind and have a bit of a guess about what it's going to do? I'd say, I wouldn't be looking at this for quite a while. And look at the resistance across here now at the $5 mark. It's got some hurdles to jump over. Did you want to say anything else about it?
No, don't buy it.
Okay, AHG. Looking at this stock, Automotive Holdings Group.
I haven't seen this one before.
Now, this has been falling for quite some time. It's even fallen through support at this level recently. Now, it has rebounded in the short term. Looking at the stock, it's at a really important level right now. So if it breaks above sort of this 250, 260 mark, there's some short-term resistance there, but potential for upside here. But it still could have one more move down as well. So, I wouldn't, let's have a look at the weekly chart and see.
I think if it can't get over that sort of 260 to 280 level, it's probably going to go down again, isn't it?
Yeah, well, the trend's up. Look at that big gap there now. Not all gaps get filled, so you don't necessarily know that that's going to come back to that level. But at the moment, I'd expect it would at least come back part of the previous range, which, that was a 54% increase. So you'd expect it might come back towards $2.20, $2 to find support from the buyers again. That'd be part of this range on the monthly chart. So AHG, I'm not excited about it at the moment, although it's in a nice uptrend. If you're in it, I suppose you'd be staying there until your exit rules trigger.
FMG, there's a few people asking about FMG. I know that.
It looks fantastic.
We did talk about it last week too, didn't we?
Yeah, it's still going. We've talked about this quite a bit because I think we even talked about this on the traders one as well that we had one evening.
We did.
Because of this level here being so strong, and it broke through it, and now it's come back, filled the gap, and it's trading up. The weekly bars range is 67 cents, which is a nice move for this stock percentage-wise, and the close so far is at the top. But it is only Tuesday, and you do not judge a stock by what it does on a Monday or a Tuesday. You wait till Wednesday's close, Thursday, and particularly Friday's close to see where it's going to end up. Just be observing it later in the week.
Well, as they say, the amateurs open the market and the professionals close it. So
yeah. But it looks nice at the moment. Now,
NAB we've already done.
NAB, we had another question about ex-dividend.
When ex-dividend today, that's what they were saying.
Yeah, okay. So what happens in the lead up to the dividend? People are buying the stock because there are lots of different funds out there that purport to providing income and through equity. So you start to see a move up into the dividend and then a big drop down. Now let's talk about the dividend, because we talked about, often banks' dividends are usually about 2% and a bit, the yield, like the individual dividends. Overall for the year, it's usually around 4.5%. And what we saw was a huge drop.
That's massive, isn't it?
Yeah, because normally what you'd look for is about 1.5 times the dividend for a fully franked share. And this has fallen more than that. So when you see a stock fall more than that, it's a warning sign that
it's a bit bearish,
it's more bearish than bullish. Yep. But look, it would have to trade back above the high of this red bar to start looking interesting. Now it could do. There'd be a nice trend line down there, but at the moment, let's just wait and see. All right, Lendlease is another one.
That's for Stephen Arts. So thanks, Stephen, for that.
Okay, Stephen, Lendlease. So looking at the chart here, you can see it gapped up. So there was this big gap on the daily chart. Okay, we had that yesterday. So from the close on the Friday to Monday's close, you can see about 8.7% up. Now, whether this comes back and fills the gap remains to be seen. It's still looking strong as at today's close. So the question is, are you in it or are you not in it? That's the question. And look, you need to have rules to trade it. Now, there is a rule that has triggered to be into this stock. Monthly swings pointing up. So in theory, there should be some short-term upside on this share. And the next level of resistance is sort of around that $14.60, $15 mark. You can see those troughs on the monthly chart or swing lows, swing highs, where it's swung down. So it may aim to push up higher. Often the momentum from news like that gets people who don't know what they're doing into the stock, hearing good news, and then the stock continues to rise for a bit. So it's more a speculator situation right now, given the big fall that it's had. Cool. So Telstra. Telstra's still holding up. The weekly bar this week so far is short. So you'd ideally want to see this move up rather than head back down into the range of last week's bar. We've still got this gap on the weekly chart that hasn't been filled. This month and last month so far trading within the same range. Now, Telstra often does this. It'll have 1 or 2 or 3 months, where it trades within the same range, it does nothing, and then all of a sudden it'll make its move. So that's what you've just got to watch for. But so far it's looking nice right now, and it's holding up well. But again, it's only Tuesday. Let's wait and see what it does at the end of the week.
Yeah, but I think this is sort of longer term bullish.
Yeah, well, it's starting to look that way, isn't it? So you've got the trend line down there on the monthly, and so that could be the bottom.
That sort of stuff, good medium to longer term portfolio, good blue chip portfolios, really nice stock to underpin it, I think, at the moment. So,
well, the news about TPM and Vodafone really helped them, didn't it?
Oh, yeah, good.
But
They've got to make you wonder why
Telstra
they made that decision, isn't it? It's like,
Are you serious?
They're concentrating the industry. Like TPG is already big in its area of providing data. Vodafone's already big in mobile phones, so how is it actually concentrating the industry when they just joined together? You got to make me think.
Well, it was more about the networks, I think, that because TPG have been talking for years about the fact that what they're going to roll out, and they haven't done it. And I think that the view was that if TPG and Vodafone joined forces, that wouldn't happen, and so that we wouldn't have that.
TPG was already starting to look at 5G and starting to roll that out, so they were already starting to do that. But it just makes sense to merge with Vodafone, doesn't it? So, and that would create a third tier.
According to the ACCC, no.
Yeah, but you got to wonder.
I mean, the ACCC have let all sorts of big retail companies come into our country, just open holus bolus, and it's just almost, just decimated the strength that
the local industry,
that the local industry have had. So it's just making a higher concentration of much bigger corporates in the industry. So I question that as well.
Well, you've got to wonder how much they pay those people for Telstra and Optus. They pay people to talk to the government to sway their ideas. So you got to wonder, don't you? Well, that's me being a what do you call it? The
well, you only have to watch the ABC or SBS to watch those programs where they have revealed certain things.
Does anybody know what happened to Uber today? I've had power out where I was, so I didn't actually see the market at all today. So did anybody know what happened to Uber today? Because it floated last Friday and went down. But I've got a couple of questions here. Can you bring up VTG?
Yeah, sure.
In a minute. Death Bum's come online and he says, "Hi, I'm sorry about my username. You guys are legends." Thanks, mate. Don't worry about your username. That's fine. Can you please look at VTG? I got in at $1.13 and added $1.52.
You got our attention anyway with that
one. Do you feel this is another pullback based on previous trends? Backtrack 3 years. Not sure. He's saying sellers outweigh buyers 3-1. That's interesting because I don't know how you measure sellers to buyers 3-1 unless you're just looking at the depth of the market, and the depth of the market is a fictional thing. It's not actual reality, and as professional traders, Janine and I, when we're placing big trades into the marketplace, we can put a trade on, let's say, for 500 shares, but we've got 50,000 shares to sell. And you don't know that, and bigger players don't show you exactly what they're doing. Sometimes we'll sit out of the market and we won't even have a sell on the market, and we'll just watch it, then just place a little trade or a trade, and then wait again for another half an hour and place another trade. So you won't even know how much we've got to trade or how many buyers and sellers. And
or we might place it in the auction, and then you won't know.
And we place it in the auction at 4 o'clock after it goes, all the matchups and that. So you won't even know whether we're buying and selling. And there's a lot of people, or a lot of, how do I say it? Manipulation is probably an easy word to say, but people put in phantom trades of, I'm going to buy this or I'm going to sell that at a certain price, and then when price gets near that, they just take it off.
Well, there are controls on that.
You're not allowed to do it, by the way.
Brokers have controls on that now.
But you're not allowed to do it. But
you
it does
can't
happen.
stop it completely. How do they do that?
Yeah, so unless somebody hands over cash for something, then it's not reality. So, to me, when you're looking at weighting of buyers and sellers, looking at that depth of the market, especially when the market's not open. When it's not open, it's worse. When it's open, it's okay, but nothing to be really, really too excited about in terms of solid strategy for buying and selling from that point of view. But this is an interesting question.
Do you want to talk about that now, or have you got some more points there?
Yeah, we can have a bit of a chat about that. We just had a few comments on the ACCC.
Uber's down 18%.
Well, here we go. Benjamin saying, I heard Uber's down 18% since IPO. Would need to verify. That's great. Yeah, Uber was down to 37 last I checked. Well, Friday closed below 42. So that means it's down, roughly another $4 or $5, another 10% or more. So that's roughly about 17%. So you're about right. But that was because I know I was chatting about it yesterday. I've just started being interviewed every week on 25 radio stations across the US, and you'll see we're actually videoing it. We're actually going to put the video up today, but we didn't get it done in time. But you'll actually start seeing that on this YouTube channel, my interview with the gentleman. And we talked about the Uber float, and I was saying, classic example of floats, and a lot of people buy floats thinking they're going to stag profits, whereas research is that 50% of the floats you can buy the stock later on in that first year cheaper.
It's also interesting the timing too, because if they had have pulled it out, maybe 2 or 3 months earlier, then we would have been right in the midst of that push up off the bottom of the market.
Correct.
They might have got a bit of momentum. So timing has a little bit to do with it as well. But, you know, with everything that's going on with the US and, you know, they've just got an excuse then, haven't they? Once it starts to be sold, then
It's
pushing
the
it
market
down more.
pushing it. It
so
really is.
So the big players decided, well, we don't need any more of this stock, because what often happens is when these floats happen, some of the smaller ones, you know, there might be particular funds that are looking to take up more. They couldn't get it all as part of the float.
I don't think that's the case with Uber, though.
Not with Uber, but with some. And so then they ended up, you know, some of these stocks got taken up and they just took off like a rocket.
They don't even make
once
money.
they listed.
They've never made money, and by the sounds of it, looking at their reports, they don't intend, like, they're not even saying they're ever going to make money. And it's like, well, how do you can survive as a business if you're not making money? And that's by raising capital. And so you go to the market and sell more shares to raise more capital so you can keep going. And that's really interesting. So from a point of view of a longer term investment, I'm not sure about it at the moment.
Look, I'll be interested to see what CAB's doing now as well. Do you want to have a quick look to see?
Oh, no, I haven't even looked at cabs for a while. It'd be interesting to see what they're doing, because in Victoria, obviously, they're taking a class action against.
Yeah, I can't remember the code.
taxi drivers.
Does anyone look at that? Because it is a smaller stock. So if you can remember, I've got New York Stock Exchange there, but if you can remember the code for cabs, then tell us, type it into the forum.
It's interesting to watch Uber over the next week or two to see what's happening. So, yeah.
All right. So have we got any more? Or
Mick King saying, can you give us a quick explanation of the closing auctions, guys? It's closing auctions not relative to you in terms, unless you're an institutional trader, it's not really something you need to worry about. But basically, it's fund managers or institutional traders like Janine and I. We put big parcels in, so do other institutionals, and then they just work out an average price, and it all just gets swapped nice and quickly and easily. That's pretty much what it is. It's called a match-up. And so we can place trades after 4 o'clock. That's why you don't get the data properly coming through till about 20 past 4 after the market's finished and the match-ups all happen and it's all washed out. So Janine and I will often put the trade in after the market's closed. And that's also why you look at the volume, let's say at 5 to 4, and you can see the volume for the All Ords for the day is X. But then the next morning when you look at it, it's X plus plus plus. And you go, whoa, what happened? That's all the match-ups that actually happens. And then you've also got dark pools and all sorts of stuff that get traded in, and you get institutional swapping shares overnight. All sorts of different things happen. So, but again, it's not really going to change how you trade as an individual trader. So we're going to look at, we're going to look at VTG, yeah? Or we've looked at that.
Vita Group, this is the next one.
Yeah.
Okay, so Vita Group, what a checkered history. Have a look at the moves on this. Now, looking at the prior high here, this is when it first listed. So just to give you an example of what happens after listing, in, what was it, 2005, the stock listed. Now, let's see how far it actually rose when it got started. We saw it move up. And I'll just expand this out so you can see it fully. Can you look across there and you can see, and I can't see my, yeah, it's hiding. Hang on a minute. Okay. So we've got about 40% gain there. So 40% gain. So that was just in a matter of what, 6 or 7 months or something? And then the stock plummeted, right? But there'll always be people that would have been hanging on after June 2006, thinking that, wow, I've made a stag profit, huge. I'm going to stay in there because I think I can make, 50%, 100%. You get greedy, don't you? And looking at that, but look, that's why it's really important to have rules. So if I just change that to the weekly chart and go back to it, you look at all of those troughs. Well, it first started to show a sign of weakness here when it just took out that low here. So this was in April 2006. Then it turned around and took off, but then it started to make lower highs. You see these highs when it moves up? So you follow the bouncing ball and the highs are getting lower. And so as it starts to drop down, and then you get a burst of buying again because everybody thinks it's cheap and, we could make more money out of this. Or people who didn't get it in the float are now trying to get it because it's cheaper and because it's gone down a bit. And then we see this massive fall that happened in December 2006. And that can happen to a lot of smaller stocks on the market after they list. So looking at that level, that prior level creates a resistance point for future. So across here, we can see that the stock stopped here in August 2018. So there was this high around $1.25. And that was within the range of what it had traded at back when it listed. So all that time, if someone had bought and held this stock, and it was in August 2018, they've made nothing really, if dividends, if that, which is not what you want to do with these types of stocks. In the first 12 months, there's a 50% probability of the stock trading below its list price, and with the smaller stocks, that can be even more so. So we're seeing that. Just have a look at different stocks after they've listed. Go back right to the start of their chart and see what's happened. But looking at how volatile this is, okay, it had a really nice rise up to the all-time high in 2016, but look how fast it just wiped out that return. So it took so long, it took years to make that return, and literally within 6 months or something, 7 or 8 months, it was gone. In 2017. So that's why you can't muck around with these types of shares. You've got to have strict rules on it. Now looking at this, we can see that there's some resistance across here around that $2 mark, which is interesting, and now the stock's just starting to have a pullback. So I'll change that to the weekly, and that's where the line is, and you can see it coming back now. It's been down now for 5 weeks. So if it takes out, and it's similar to what our market's done, if it takes out that low, I'd be quite concerned about it coming back, towards this $13, $20. So it is a risky stock.
It is a risky stock. Now we've got just last little comment I want to make just before we finish tonight, in terms of that we had D-Wave saying, which one works better to determine the future by reading the past cycle hyperwave or technical analysis? Now I don't know about you, Janine, but I've never heard of hyperwave. And it depends on what you mean by technical analysis, because my version of it and Janine's version of it and other people's version of it is completely different. A lot of people use a lot of indicators, and that's technical analysis, and it is.
Not to us.
But not to us. We don't use it. Hyperwave, it's either absolute BS or it's another name for something that Janine and I already know about, because we talk about price pattern time, and we use price pattern time in our trading all of the time, and using cycles theory, but we don't use hyperwave theory. But it's probably just another name, as I said, either another name for something we already know, or it's BS, complete BS, because there's so much BS that we see people put out in YouTube videos that sounds sexy and everything else, but you try and use it, you'll lose a shed load of money. So
look, I can remember when I first started learning, and I was looking at, who's talking about this? It was always some new thing that they were talking about, and especially when you're starting out, there's so much to learn out there. But what I realised was that you've actually just got to stop and focus on a few things and get those right first. But it took me a while to realise that, because I was interested in, should I say it, the planetary alignments and all of that sort of stuff for a long time. But you don't need all of that stuff to make money.
Well, probably the easiest example that I can give people is I get so many people saying to me, do you teach swing theory? And I go, okay, so what do you understand about swing theory? And every single person that's ever said that to me, swing theory, doesn't even understand what swing theory is. And they've got these weird ideas of what swing trading is or swing theory is. And most of them, they don't know how to get it, but they want to do it because they've read it on a chat forum, or somebody says it's great, or they've seen a bit of it on a YouTube video, but it just doesn't work. Swing theory, swing trading, proper swing trading is amazing theory, and it will make you absolute truckloads of money if you understand it properly, but most can't even explain it. So that's really sort of the idea of what I was trying to say is...
But you need to learn, when you're using those theories too, you need to learn how to tweak them, and you've got to have a set of rules, like a kit bag of rules, so that you can do that, because swing theory is not going to work from point A to point B forever and a day, and it may actually end up giving you a low win rate in the long run, but you don't know until you've tested it. So that's what, over time, that's what we show people how to do well.
What a big show.
We're probably
so
up
much.
now,
Thanks,
aren't we?
guys.
Thank you for all your questions, by the way.
Heaps
really
of
good
great
ones.
comments on the chat tonight, and really good questions, and challenging Janine and I. The more you ask and the more you challenge us, the more we're going to give you. It's pretty much as simple as that. So, and really, Janine and I do love it when you get involved in how this show runs. Now, this is about supporting you, supporting everybody else on it. So, that's what we're trying to do, is create that supportive environment to help you fully understand the marketplace. So.
Yeah, I mean, I really like it too when I see all of you guys out there so keen to understand the right way to invest in the market, and not just any way. Now, before we go, I'd like everyone if you haven't subscribed, then please subscribe. Help us to keep up to date, for you to keep up to date, because then it's much easier for you to find out what's new on the channel.
Yeah, and if you've enjoyed tonight's show, please share it with your social media friends, your colleagues, that sort of stuff. So let everybody know about the show. Love to have more people on board.
Also, Dale and I'd love to see you again, so make sure you put this show in your calendar and get back online next Tuesday at 7 p.m. as usual.
We'll be here, won't we? So also, if you can get on and send us your questions anytime. So if you've got a question or a comment or a stock you want us to look at on the show, but you can't be online live, just shoot it through to info@wealthwithin.com.au. We'll bring it up on the next week, and then you can watch the recording, as I said, if you can't get online. So just type Wealth Within in the subject line of your text, your email. So that's info@wealthwithin.com.au. But Janine, that really does bring us to the end of another show.
That was too quick.
I know it's really. I really hope I've really enjoyed it, and I know. Well, I do hope everybody else enjoys it as much as I do, and I know you do. You do as well. And we are thanking you for taking part, and we do hope to see you next Tuesday at 7 p.m. So for now, goodbye, good luck, and good trading.
Good night, everyone.